Good afternoon, everyone. Thank you for joining us for today's Lunch and Learn. I'm Lauren Smith with the International Franchise Association, and we have a great 30 minutes lined up for you. Before we begin, I would like to let everyone know that we are recording today's webinar and will make it available later this evening on community.franchise.org. If you have any questions for today's speakers, please add them to the chat box and they'll be addressed towards the end. Today's topic is franchise development in a post-COVID environment. Here to provide today's discussion is Ron Feldman and Jamie Davis. Thank you, Ron and Jamie, for joining us today, and thank you, ApplePie Capital, for sponsoring today's Lunch and Learn. I'll go ahead and turn things over to you.
Thank you very much, and welcome, everyone. Hope everyone's having a great day wherever you are in this great country. We're going to try and cover a fair amount of content in 30 minutes. If you do have questions, as Lauren said, just type them in the chat. We are monitoring the chat, and we'll try to get to it live if possible. A little bit about who we are. We're ApplePie Capital. We only lend in franchising. We don't lend in any other business model. So if you are a franchisor and looking for a lending program, we are probably a call that you should make. That's me on the left, and that's Jamie Davis on the right. Jamie is a new person to join ApplePie, coming out of the franchise development world and learning the lending business. But we are, as I said, 100% franchise focused, and thought it would be very important to have somebody who had expertise in franchise development on our management team, and he'll be joining me in this presentation.
Good to be with y'all.
So we're going to talk about three segments of franchising: startup, what we call emerging, and then mature. You can see the number of units that are there. Where these are not industry standards; these are ApplePie buckets, and we'll see where we go from there. Jamie, why don't you take it from here?
Sure. Actually, I was going to pick up at the next one, but
Oh, okay. Never mind. My bad. I can't.
Sorry.
So these are strategies that are overall really important in helping your franchisees and your prospective franchisees figure out, number one, how many units they should actually get, how they should capitalize those units, and knowing how they need to be ready to grow, because you really can't grow out of mediocrity. If somebody signs a 3-pack or a 5-pack and their first unit comes out of the ground and they are below average, you're not going to have a whole lot of success, at least in our experience, having them open more units to still be below average. So you want to make sure that you, as the franchisor, this is your problem, because when units close and your item 20 shows those terminations and those failures, it's bad for franchise validation. It's also bad for lenders who know how to read an FTD.
So in terms of pitfalls for startup franchisees, you know, as a franchise development professional for 15 plus years, dealing most of the time with new franchisees, these resonate to me pretty significantly. You know, the inexperience with applying for financing. Most of the startup franchisees that I dealt with didn't have a whole lot of experience in dealing with lenders and figuring out how to source lending, how to put together a franchise, a loan application, a business plan, all those things. That kind of can get in the way of getting a startup moving. You also see people that tend to move toward wanting to not secure a whole lot of debt, and so they want to use a lot of their money, most of their money, to avoid going into debt. But as we know, what that does is it just it puts the kibosh on future development, because they don't have any dry powder left to continue to fund growth down the road. Relying on the FTD for all costs, you know, I think every time I talked with franchisees after doing validation calls, they'd come back and say, "Well, you're your franchisees are telling me that I need to be looking at twice what you got in working capital. And I think that's a common piece, all up and down item 7. So making sure that we're dealing with real numbers and fully understanding what the investment looks like is an important piece as well. And then selecting the financing path as well is important. So, Ron?
So, yeah, and I'll just add one point to this.
Yep.
Everyone's FTD that's building a unit today, for the most part, is from an FTD that had 2020 construction costs in it. And we all know that's not true. There's anyone who has brick and mortar or vehicles in their item 7, those costs are significantly higher than what they originally built their plan on. And if you're in a brand that has a long real estate window, you want to do a check-in with those folks and make sure that they can actually get to the finish line now. They might be undercapitalized based on your old requirements. And when you're doing your new requirements for this year, you want to make sure those requirements are moved up along with the actual costs of opening a unit. What are the products that are really available for first timers? SBA. In some brands, you can get 90% of startup costs. You get 10 years to repay, floating and fixed rates. I'll cover the interest rate, bull in the china shop here. Interest rates are going up. The word on Wall Street is a 0.5 point this month or next month, and a 0.5 point in June. So prime rate's going to go up by at least a point in the next 60 days. And they've indicated 7 more increases over the next year and a half. That means you might have the prime rate at 7.5 or 8% if this inflation continues the way that it does. You really need to stress test your P&Ls and see how that works if somebody's taking that big of a loan, not 90% of a loan, and their interest rate goes up. Figure out what that payment is based on what you believe that loan to be. The ApplePie core product, not for every brand. We're very selective in who we'll do first units for in our conventional lending product. But we can do actually higher than 75% now, depending on the brand. We put 75 out there as kind of the rule of thumb. It looks a lot like an SBA loan in terms of a 10-year term. But we do provide a fixed rate for the term of the loan, so the startup franchisee is not taking any interest rate risk. We also don't take personal collateral. We don't take your house. We don't take your stocks and bonds. We do take personal guarantees, but we don't take your house. How do you do it? It's usually a combination of one or all of these 4 things. And, if it's someone else's cash, you want your friend, you need to know whose cash it is, and you want to see the agreement between the shareholders. Because if the shareholder agreement between the 2 of them is that the person that gave them the money to get started gets 100% of the free cash flow, that's not a good thing. If somebody's using a 401k rollover, and I saw on the attendee list a bunch of friends that are companies that do that, and they want to open 4 units, it's usually not the right strategy to use 100% of their equity on unit 1, as Jamie indicated earlier. So it's usually a mix and match of those things. I will tell you that for first timers, they've probably never gotten a business loan. I'll put the persona out there of the corporate refugee who left corporate America, who's going to start a business, a franchise as their second career. We're all seeing those people right now with the Great Resignation. You really need to help walk them through this as the brand. They're buying you, they're buying a franchise because you're supposed to give them a brand, and you're also supposed to give them a system. And part of that system is finding the right way to borrow money or the right way to capitalize their business. What are the pitfalls and challenges that we see? Liquidity I touched on. That cash is king, and it always will be. You want to make sure your franchisees have the right amount of cash in the bank to properly capitalize their business. Merchant cash advances, we all get inundated with these emails. Get approved in an hour, 550 FICO score. What they don't tell you is it's a 50 or 60% interest rate, and they're taking money out of your account every day. If your franchisees are taking merchant cash advances, they're probably in a bad way, and you probably want to get your field reps there to try and help get them through that. On the complete opposite side, people that are so interest rate sensitive that they don't want to grow, or they lose the opportunity to grow because they only want to pay X percent. If you're in growth mode, and this is something that you can teach your first timers and your existing franchisees, if they're in growth mode, it's not about the cheapest capital, it's about the most flexible capital, and it's about the lowest monthly payment they can get, so they can reinvest their free cash flow into growth. The other thing that we see is, and I mentioned this earlier, I'm not profitable, but I'm going to build 3 more and I'm going to be profitable. That's not a good strategy. And these are things you need to be upfront and discussing with your first time and your existing franchisees. Their capital access is something you need to be active in, especially with rising interest rates. And generally with rising interest rates, you see tightening credit markets. So you're going to see both of those things if history repeats itself, which it usually does. Jamie, anything to add to that?
Yeah, I mean, I would just, I can't tell you how many times I've seen people try to convince our operations folks on the franchisor side that, if I could just get this other unit up and running, everything would be great. And like you said, you nailed it. You can't grow out of mediocrity. So.
What are the options for the existing franchisees? SBA is sort of an option. It depends on how fast. If I had you in a room now, I'd ask you all, how many of you actually enforce your development schedules? If franchisees if they're using SBA, they can't have a development schedule. So save yourself the time in the beginning. If they're using an SBA loan to open unit 1, don't bother giving them a development schedule, because most SBA lenders won't let them build unit 2 until they see at least 1 tax return from unit 1, which could be 23 months after they open or 18 months after they open. So you want to make sure that if you have franchisees that are growing, that they have other options outside of SBA. The ApplePie product is built for this. We can talk about that after the fact. If you're interested, you can give Jamie a call, give me a call. Conventional lending. Everyone always says, I want a conventional loan. Well, conventional franchise lending is defined by someone who only lends against the units and doesn't take any personal collateral. So they're not leaning their house, they're not leaning their stocks and bonds. If you have less than 5 units, unless you're in one of the tier 1 brands that are out there, the conventional lenders are not going to talk to you. They're going to want to make sure the franchisee has 3 to 5 years of experience operating inside that brand, and that the brand is big enough to support their debt. There's a whole plethora of qualifiers there for straight conventional franchise lending. What do the larger franchisees do? What mistakes do they make? They don't use the equity in their existing business to fund their growth. That's something that we see every day. That is the fastest way to grow outside of just stroking checks out of your savings. Excluding small costs, they don't borrow enough per unit so that they end up using up too much of their cash to continue their growth curve. And then loan covenants. I don't want to go into every kind of loan covenant that's out there, but I'll talk about one specific, and that's a post-distribution cash flow coverage ratio. That covenant is in most conventional lending loan docs, and what it's saying is that you need to leave X amount of money in the business even after you pay yourself. And what happens when you trip a covenant? Your interest rate goes up. They can call your loan. Those of us that have been around this business since 2008 and lived through 2008 to 2012 know that a lot of banks called loans because of covenant trips, covenant breaches. If we go into a down economy, and I'm not saying we are or we're not, but there are a lot of people saying that we're going to, you're going to have your franchisees breaching covenants, and you want to have a plan for them to deal with that. So again, overarching theme here is capital access is something you need to be participating in as the franchisor. Again, the options here. Here's where, once you've got over 5 units, conventional lending is a real option if the brand's big enough. By the brand being big enough, I'll say 300 or more units to get the regular franchise lenders that we all see at the conferences interested in your brand. If you have less than 300 units, you're kind of not ready for them yet. Our core product, if your brand's approved, we are pretty generous with the terms and with the capital that we bring to the brands, but we are pretty stringent on what brands we'll work with. And one of the things we see with mature franchisees is they literally run out of SBA money. Jamie, you worked at Primrose. What did you notice when Primrose franchisees tried to grow beyond their SBA limits?
Well, 1 unit, basically. I mean, our investment was 5.5 to 7 by the time I departed Primrose. So, you're right up against it with your first unit. So weren't able to grow real quick that way.
We're seeing that in a lot of the big box franchises that are out there now, and there's a fair amount of big box franchises. On the flip side, and we don't have a slide on this, if your investment size is less than 300,000, there's fewer lenders that are interested in working with you. The reason for that is it costs the same amount of money, at least in an SBA loan, to process, underwrite, and close a loan for 150,000 or 200,000 as it does for one for 500 or $1 million. The other thing that Frandata pointed out last week, I think it was last week at the multi-unit show, I think it was only last week,
A couple weeks ago.
Yeah. Is that the lower investment size franchise brands have higher failure rates than the higher investment franchise brands. Monitor your item 20 like it's your gold mine. Your item 20 is what will make banks either interested or disinterested in your brand.
It's the first stop.
Yep. When we train our credit people to read FTDs, first thing we look at is item 20 before we look at anything else. And then there's a hard pass if item 20 is not good. We don't have to read the rest of the FTD. Here's just a quick chart on all the products that we've talked about today, and kind of where things are. I'll just call out a couple of things here. ApplePie Core's got a lot of checks there. Those checks are only there for a subset of brands that are out there. If you're interested in talking to us about your brand's approval, please give us a call, send us an email, chat something in the box, whatever you want to do. SBA is generally available for most every brand except perhaps the Wall of Shame brands. Those are brands whose item 20 shows negative growth, shows more closures than openings. Those kinds of things. Even the SBA lenders are looking at that. Conventional lenders we talked about, and then the last column of equipment and remodel. If you have a reimage coming in your brand and you're going to ask your franchisees to put up some money or to borrow some money to do that, couple of value points here. One, you want to make sure that the numbers work, that there's ROI on that, and you want to test that either with, if you don't have corporate units, with certain franchisees that you sponsor to do it, to show that there's a lift in sales for doing it. If you have corporate units, do it in your corporate units. The other thing is you want to make sure your franchisees, when they do this, have enough lease term left to get their ROI on it. You don't want a landlord throwing somebody out of a unit after they just spent $200,000 on a remodel 2 years earlier. So you want to make sure that you're in the right place when you're doing remodel. I see one question that just came. How do transfers in item 20 impact bank lending? There's percentages that are kind of industry standard, and if it gets above 7 to 10%, it's going to raise a question in a franchise lender. But, and I hate answering questions with the words, it depends. But it depends. If your brand is 8 years old and you have 10% transfers, that's a very different story than if your brand is 38 years old and you have 10% transfers. Hopefully that makes sense. Where I'll throw out there, where brands bury their skeletons is in the far right column before the totals of their item 20, called ceased operations for other reasons. I've done a lot of digging for skeletons, and that's where I find most of them when we do our brand underwriting. I will tell you that transparency matters in your item 20. And if they are for other good reasons, you're allowed to footnote that then and put it right in your FTD. The other reason was they had 7 units and they consolidated, so they only needed 5 because they realized they built them too close to each other. That's okay. But leaving that blank without footnoting it, and I'm sorry, you all probably did your item 20s for this year, and we're just doing this at this webinar now, but put it on your notes for next year. That column is where there's a lot of skeletons buried. And if you're burying those skeletons there and you know it, you're probably smiling, but you're not on camera. That is clearly the number one thing where we've noticed brands trying to not be forthcoming in their closures. Most banks take a pretty standard approach. If units stay open, the bank can get repaid. Pretty standard there. If units don't stay open, the bank's not going to get repaid. It's a little bit about our lender network. We work generally creating programs with franchisors where we will create a specific finance program for first-time franchisees, for existing franchisees. We work through the origination, the underwriting, the close, and the service of those loans. And we have capital partners that buy those loans from us. And we have enough capital on hand to fund all of 2022 and 2023 right now. We're looking for, to go to that movie, a few good brands to join our network and join our club. And that's kind of the ApplePie way of doing things. We do not do 401k rollovers. There are great IFA members that do that. And if your brand is growing specifically and only through SBA, we're probably not the right person for you to talk to. What are some key takeaways here? The guy who taught me most that I've learned in franchising was a guy named Anthony Martino. Many of you have heard me speak, I bring this up quite often. He started 3 franchise companies, Amco, Mako, and the Goddard School. I met him when I was a franchisee in the Goddard School. And his line about franchising was, franchising is simple, provided franchisees make money. This current economic environment is wreaking havoc on the world. It might be wreaking havoc on your system. If your prime costs are up, if everyone's costs are up, because everyone uses fuel to get everything to their units. So everyone's costs are up in some way or another. Building costs are skyrocketing. Supply chain issues, getting HVAC for certain brick and mortar brands is a challenge. Interest rates are rising. Everyone's going to get depressed after this call. I'm sorry, but this is where we are. You need to be in the game, working with your franchisees and helping them navigate these waters. If you leave them out on their own, what's going to happen is your item 20 is going to start to be one of those ugly item 20s, because you're going to have units go dark, and that's not something that you want. Knowing the SBA rules, or have an advisor, sign up with one of the, the IFA members that does the SBA brokerage, or one of the 401k folks. If they're signing a 3-pack, you need to know how they're going to open unit 2 before unit 1 is open. You just need to know that, or else unit 2 is never going to get open. And then the person that wins, and I don't know, we probably have lawyers on this call, but then the lawyers win. So you want to make sure that you have properly capitalized franchisees. Unit economics and transparency matter. We covered that all over. As we go into a down economy, there's probably going to be some level of thinning of the herd of those weak franchise owners that aren't going to weather this storm. Think about that today. Think about who your strong franchisees are that might gobble those folks up if they're in good locations, and keep those units open and keep your item 20 looking good. And for you emerging brands out there that are living off those initial franchise fees, just have some common sense. Selling somebody a 10-pack that's never going to get open is going to result in you having higher legal costs down the road. That's what the outcome is going to be. So with that, we have a couple of minutes for questions. Anybody have any questions? A recording is being made of this. It's going to be on the website, and the slides will be in the recording. If you want just the slides, please email Jamie, that's JAMIE at applepiecapital.com. What's the best way to educate your franchisees on these topics? If you don't have a supplier like us, or one of our competitors, that's the best way. Bring a lender in, and let the lender who knows what they're talking about talk to your franchisees. If it's on your business model, we can't do that. You need to own your business model. But if it's on lending, the capital markets, bring in an expert.
The earlier the better too. I mean, in my experience, had I had something like this, a partner like this, during my franchise development career, it would have eased a lot of pain, especially in the early going. Getting new franchisees up to speed on how to secure franchise finances is really a key.
Yeah, and I'll leave you with this. If you've got an in-person conference scheduled this year, many brands are, you need to have a workshop on this. You need to have a workshop on how we're dealing with inflation, how we're dealing with the labor shortage, how we're dealing with these things. Your franchisees are looking to you to bring the system to them to execute. They're not looking to invent the system themselves. Otherwise, they would have opened a business and not bought a franchise. So we have 30 seconds left. We put up in the chat where the email addresses are if you want to get the slides, and I'll hand it back to you. Thank you.
Thank you. Thank you so much, Ron and Jamie. This is excellent content and excellent feedback from all of you. We really do appreciate it. Again, this webinar was recorded and along with the presentation deck will appear on our website early this evening. You'll be able to find that at community.franchise.org. Thank you very much again to Ron and Jamie and the ApplePie team. And again, thank you to everyone for joining in. Have a great rest of your day. Stay safe and healthy. Bye.
Thank
Thanks
you.
all.
Bye-bye.